And here we go with episode 3 or 4 or whatever it is of stories from Reddit. And today I really wanted to make this quick video about this guy. He posted how this is his first trade of the week. We have a gold chart here on the 12-minute chart. I don't know why they're 12-minute. I don't know what's going on here, but whatever. And he posted that he made 290 pips on this trade today. And he also included a screenshot of the chart. And as we can see, there are a whole bunch of sell positions here on the screen. Now, this, to anybody who has been trading for a while now, is already a red flag, right? This guy is talking smack. He says he's making money. He's making 290 pips. He's got a whole bunch of sell positions open. So anybody who knows what trading is can tell that this is crap, right? This is bullshit. This is not how long-term profitable, sustainable trading looks like. And also, anybody who brags with pips doesn't really know what they're doing. The only thing in trading that matters is R return, so unit of risk return, in comparison to an equal benchmark or an equalized benchmark. Usually that would be S&P 500. So what I'm talking about here is risk-adjusted returns, but more on that in separate videos. Today, let's just explain why 290 pips profit or gain or whatever by itself means nothing, right? Because pip in foreign exchange is just a unit of measuring the distance that the price traveled, but we don't know how heavy the position was. So if you're opening a 0.01 lot trade over 290 pips, or if you're opening, a 10 lot trade over 290 pips, those are two completely different stories. And that's why it's very important to understand this whole concept of what's a pip, what's a lot, how these two correlate with each other, how everything risk-wise works, right? Because pips by themselves, like I said before, don't mean absolutely anything. A good thing this guy could say would be, I don't know, in this position, I risked 1R, or I don't know how many, whatever currency value that would be, or whatever percentage value that would be of his capital, and I was aiming at a 1 to 2 or 1 to 3. The price hit the take profit target, and that's it. But what we see here is just a bunch of sell positions, like 10, 20, 30 sell positions, basically zero control, gambling essentially on what the price will do. So you're predicting the market without any real control, because risk is the only thing you can control. And if you don't control risk, you're basically not trading, you're gambling. And when I called the guy out in the comments, of course, he said that he's only, spamming the sell button when there's an A+ setup, right? But that doesn't matter. It could be an A++ setup. It could be the best setup in the world, a setup that you win very, very often. But, when you don't win a trade, the loss would be so catastrophic that basically your capital would be wiped out. Well, I'm not saying that's the case of, in 100% of the examples, because there's a lot of people who manage risk in a dynamic way, not, risking just 1% or 1 hour per trade, but they do it a little bit differently, like scale in, like, a couple of positions at the same time, or they have a thing that kids nowadays call a mental stop, or, whatever. There are ways that you can manage risk more dynamically, but this is not it. This guy's is pure gambling. This guy saying he made 290 pips, right? So what? What does that mean? You didn't make 290 pips. That's not a thing, right? If you did make money, you made, I don't know, blah, blah, blah lots, exposure over blah, blah, blah pips. So you made an X amount of money, you made an X amount percentage return, you made an X amount of gains, right? But pips in themselves are nothing.